Hey YouTube, welcome back. It's Dave again with Military Money Mastery. Today we're going to be going over the F&G funds. Super safe funds. We're going to be talking about, all kinds of stuff about them. Let's break it down what we're going to go over today. So we're going to go over what the F fund is, we're going to go over what the G fund is, the risks and the advantages of them, because there's both, when to invest and how to invest. So just a little breakdown of them. The G fund last year got a 2.71%. Growth, which was actually better than the C, S, and I funds because they were all negative last year, right? F fund also got 0.15, which looks really low, but still better than nothing, right? Or still better than negative, which is what a lot of the funds did. So the F fund is going to be U.S. bonds, and then we can look at how the performance has been since inception. So the F fund came about in 1989. It's gotten 6% since then, which is pretty solid, pretty good, pretty safe. Over the last few years, it's definitely been in decline, but the first few years when it originally came about was really good. And then the G fund has gotten 5.03% since inception in 1987. I think it was April 1st, so April Fool's Day. But yeah, we're going to go in depth about both the funds, and we're going to talk about when you should invest in them, and like what you should do when you're investing in them. So F&G fund, is it really the safest way to invest? Can it be true? Yeah. I'm going to tell you how it can be. We're going to go over all that stuff. It's pretty interesting. So let's start off with the F fund. F fund's an investment system that's objective is to match the performance of Bloomberg Barclays U.S. Aggregate Bond Index. I know it's kind of a mouthful if you couldn't tell. It's a pretty broad index which represents the U.S. bond market. It mostly consists of high-quality fixed income securities with maturities that last longer than a year. This consists of like treasury bonds, agency-backed securities, corporate bonds, stuff like that. If you can see right here on the screen, you got the F fund right here. Pretty cool. So yield to maturities 2.72%. Average duration of the bonds and whatnot was that 5 3/4 years. So it's pretty long bond market. Let's go over the G fund a little bit. So the G fund's main principle is to maintain a higher rate of return than inflation without exposing risk of changes in market prices. So that means that it's you're not subjecting any of your money to risk. If you look at the rates of return, always been positive, right? You can look at the G fund or the F fund, and it's been, there's one negative year, but for the most part, it's always been positive too. So they're both very safe. So a little bit more about the G fund. So the fund investment is short-term U.S. Treasury securities, which are specially issued to the TSP itself. Principal payment is guaranteed, so they're guaranteed to make money. So there's actually like no risk unless it doesn't beat inflation. And by law, the G fund must be invested into non-marketable U.S. Treasury securities, which means it's like as safe as it gets. So let's go over what the risks are. So both the funds are extremely safe. Like I don't think you can get much safer than these funds. The only real risk that you have is with inflation. So if inflation happens to beat one of these funds over a year, then you might not make as much money, or your money might not be as valuable next year as it was this year. And also, it's not necessarily a risk, but you can actually make more money in the CS or I funds, or even the life cycle funds. That's not necessarily a risk, but if you're going for a long term, especially when you're younger, it's better to invest a little bit more risky. That way you can make more money over the long run. So what are some advantages of it? Obviously, it's very low risk, and there's almost no chance for a negative return. You look on the F fund, and you had one negative year, but other than that, everything's been very good. And same thing with the G fund. F fund has slightly higher rates of return than the G fund, but the G fund's also safer, right? So that's usually how it goes. With high risk comes high reward. When should I invest in these funds? So anytime that the market's going to be down, you should invest in these. If you know the market's going to be down, invest in it. If you think the market's going to be down, invest in it. That's pretty much it. Also, like when you don't want your money to be subject to risk. If you're going to be doing the Warren Buffett approach, which is the basically 90% in the C fund and 10% in either the F or G fund, you're going to put 10% into one of those funds. So like do the F fund if you really want, or do the G fund. It depends on how safe you want to be with your capital. If the market's going to be taking a turn, or you feel like it's going to, it's not a bad idea to put a large majority of your money in there. I did that last year towards the end of the year quite a bit, and it actually saved me quite a bit. I didn't lose nearly as much. And then, you know, once the market starts to pick up, then you just move your money back over to something that's a little bit more risky, something that's going to make you some more money. Also, if you're retirement age, you know, it might be beneficial to put your money into one of these funds just because you don't want to lose it, and this is the money that you're living on. So it's a good idea to put your money into one of these funds if you're in retirement. So we'll go over like how to find out about these funds. So obviously the G fund and F fund, go to the TSP website, right? Investment funds, and then you can click on these videos. The YouTube videos are very, very informative. They're pretty helpful. Here's some graphs. Here's the performance models of them. So you can see monthly returns, kind of okay. You know, the F fund is a little bit more volatile than the G fund, but it also can earn higher. You see 8% in 2011, where, you know, the G fund probably got like 2.5% right around then. The F fund also would have made more money since inception than the G fund, so something to take in consideration. But if you're doing it just monthly trading, or just trading a little bit here and there, you know, like maybe take a look at one of these and see which one you really want to get into. Here's another model that shows, you can see right here, this is the financial crisis of 2008, and then you also have the .com collapse, and you look at the G and the F fund, which are these two gray ones, and they are just steady increase, very steady, very safe. But look at all the other ones, you know, huge crashes. So if you would have sold or got out of your G, S, or I right here, or C, and just dropped into one of these funds, you know, you'd be doing really good. So that's just something to take into consideration. So we're over the next future episodes, we're going to go over some of the L series funds. There's quite a few of them. They're pretty good to invest in if you don't know what you're investing into, or you don't really want to pay attention to it that often, or say you're going on a deployment and you have really poor internet connectivity and you really want to just put your money somewhere where it's gonna make a little bit, you know, and you don't have to really worry about it. It's a good place to do that. And we'll talk about it next week. But anyway, it's been Dave from Military Money Mastery. Thanks so much, everybody, for tuning in. Please hit a like and subscribe, and tell everybody you know about it. It really helps, and I'd really appreciate it. Get the word out there. Get people thinking about this kind of thing. That way, in the future, they're set up. And I can't tell you how much it's helped me just to look at this kind of stuff and learn how it works. Anyway, Dave from Military Money Mastery. Thanks so much for tuning in. I'll catch you guys next time.